Today we're going to talk about how to spot a good buying opportunity in a single stock. Before we do that, take a moment to read our disclaimer, which you can see on the screen right now. Okay, we're going to talk about DataDog, which is an enterprise software company that IPO'd fairly recently and has been on a growth tear since then. The stock ran up, peaked at the end of last year, along with most growth stocks, has since sold off, and we believe that right now represents a pretty interesting opportunity to buy the stock. And indeed, we think that institutions are accumulating this name right now. For disclosure, Sestrian Capital Research staff personal accounts hold long positions in DataDog. We are long DataDog, so you're clear. Let's talk about the fundamentals. So we have two views on the numbers here. We have quarterly data, which, as you know, is a fast twitch measure, and then trailing 12-month data, which is more of a slow burn flywheel type of measure. Let's just look at the quarterly numbers so far. This is up to and including the most recently reported quarter for June this year. So revenue growth in the most recent quarter was 74% year on year, which is a high growth rate for sure, but that growth rate has dropped for the last two quarters sequentially. Gross margin high at 80%. A good software company will have gross margins in excess of 75-80%. How you measure that is you take the variable cost, the cost of goods sold, away from revenue. And in a software company that doesn't have to buy assets, it doesn't have to buy components to assemble it, doesn't have to buy inventory, then you have a high gross margin. It's one of the reasons that software is such a good line of business to be in. EBITDA margins, which for these purposes we add back stock-based compensation, and we can talk about that another time. Margins are high in DataDog, so the most recent quarter had 22% margins, which for a 74% growth business is impressive indeed. And then more importantly, in our opinion, unlevered pre-tax free cash flow, which we measure as EBITDA minus CapEx minus change in working capital. It's been positive for a very long time at DataDog, unusually for a high growth business of this youth. And in this current quarter, it scored an 11% cash flow margin. Let's look at the slower burn data, which is all trailing 12 months revenue from each measured point. So let's again look at the June quarter. So the business has just shy of $1.4 billion in trailing 12-month revenue now. It's growing that book of business, that book of revenue at 79% a year, which is terrific. That number will probably come down a little because those quarterly fast twitch numbers are coming down a touch. Trailing 12-month EBITDA just shy of $300 million. And again, more importantly, trailing 12-month unlevered free cash flow, again, just shy of $300 million. So cash flow and accounting profit are very similar in this business. That's a good sign of high quality profit. Trailing 12-month cash flow margins, 21%. Again, that's extremely high for a business growing at that rate. Margins have dropped a touch in this recent quarter, but nonetheless, that remains very high. And the balance sheet's very strong with almost $1 billion of free cash on the balance sheet. You'll see we use net debt, brackets cash, brackets in red means positive amounts of cash. So that's just short of $1 billion in cash on the balance sheet, net of any debt the company has. Now, the one flag for concern in DataDog now is the slowing growth of the order book. If you look at the 10Ks, the 10Qs of companies like this one, sometimes the earnings releases, but very often you have to look at the SEC filings. You'll see something called remaining performance obligation. Companies don't make it easy to find. You have to search for it. Apple F-it, Control F-it. Remaining performance obligation. RPO means the total value of the outstanding contract book that the customer has with the company has with its customers. And what you're looking for is a large order book as a percentage of TTM revenue, which it is at DataDog, and you're looking for a high rate of growth in that order book. Preferably, you want the order book to be growing faster than recognized revenue. And in DataDog, that was true until the December quarter this year. So you can see huge rates of growth in the order book through 2021, and even at the December quarter, the order book was growing at 88% versus revenue growth at 70%. So that's obviously encouraging for the future. The order book growth, though, has dropped sequentially in the last two quarters, a little bit in Q1, but a lot in Q2. And so one cloud, no pun intended, on the horizon here for DataDog It's just that drop in growth in orders. To be clear, 51% in growth in orders is still really good, but it's slower than the revenue growth rate. And so that's just a concern. It's something we think the company will need to address over the next 2-3 quarters just to support the stock. Let's move on and look at technicals. DataDog is a recent IPO, as I mentioned. Now, for recent IPOs, we like to start our stock charts at 0. If that sounds a bit strange, it probably is. On the other hand, it does give us some nice predictability with the Fibonacci extensions and retracements in the system that we use. So this is DataDog on the daily going back to IPO, and again we start at 0. So what's the stock done? It's put in a large degree wave 1 up from that notional 0 to the Q4 peak last year, just shy of a couple $100 a share. It peaked alongside the Nasdaq and the S&P and most other growth stocks. It then put in a larger degree wave 2 drop in a typical A, B, C format, and that wave 2 looks to have troughed right above the 61.8% fib retracement, which is a textbook wave 2 low level. Now the stock's at a pretty interesting point right now, and this is why we think that technically the stock offers a pretty interesting buying opportunity. We think that this stock is under institutional accumulation. In other words, we believe that institutions are buying the stock in anticipation of a move up in the price. Why do we think that? Well, first of all, it's found support at a key technical level. Secondly, it's operating in something of a sideways range since these June lows. So whenever it's moved up, it's sold back off down again a little bit, moved back up, hit that resistance, sold off down a little bit. And these sideways ranges can very often be indications of institutional accumulation when they're at a low point. If you see that sort of sideways range at a high point, that's often institutional distribution or sales. But down here, it can very often be accumulation or slow, careful buying. Further evidence of that comes from the volume profile. So these blue and yellow bars on the right-hand side here show the volume of shares traded at any particular price point, not the conventional volume per time slice down here, but this is per price point. And if you look, the so-called high volume nodes, the areas where the biggest volumes are traded, it's right in this zone here. And we can't show it on this chart, but our friends at TrendSpider have a nice tool showing the percentage of sales that comes from retail trading. And after the February 14 period, where there was a brief spike, the retail percentage of trading in DataDog is very low indeed. And so this 3 pieces of evidence there does look like institutional accumulation to us. Now, if this is an opportunity that you are interested in and you think that buying now is a good idea, then here's how we think it can be played. The recent lows here mean you can place a stop without too much risk. In other words, if the stop were to trigger, then you haven't caused yourself a large realized loss in your account because the low was relatively proximate. So we think stop zone should operate somewhere below these recent lows. This accumulation zone, we think, well, why not mirror what it looks like institutions are doing? So why not try and buy somewhere between the 80, 85 and the 110, 115 zone? Why not try and build up a position in that zone for as long as the stock is there, not buying all the position on one day, probably not buying it on bright green days, probably buying more on red days, but accumulate in that area. Now, the next up target in this standard wave pattern, and once you've seen a wave 1 and a 2 like this, the wave 3 that follows can reach at least 100% extension of wave 1. That's a fancy way of saying that you take the stock price movement in that wave 1 and you add it to the stock price at the bottom of this wave 2, that's your 100% extension. And in this case, that's around $280 a share, which sounds crazy. It's nearly 3 times your money from here. But this is a high growth stock. It's a high beta stock, which means it tends to overreact to the upside and to the downside versus the S&P. And so moves like this are not at all uncommon. And the fact that there is accumulation down here is in part, if there is indeed accumulation here, is in part in recognition of the fact that you do sometimes get these big moves. So you could see an upside target at 280 or in fact above, but let's leave it at 280 for now. If you buy the stock and it does start to move up, then of course you can use risk management techniques, you can take profits on the way, you can move up your stops, all manner of things that you can do in a way that suits your financial and emotional profile. After a wave 3 target, if that happens, it's very common to shallow wave 4 down. We had a deep wave 2 down. Deep wave 2 usually means a shallow wave 4, and so we've just modeled this out to be a 38.2% retrace, which is a very common wave 4 retracement, and then a wave 5 higher, which we've modeled cautiously as just peaking above the wave 3, which is the minimum definition of a wave 5. So that's DataDog. Strong fundamentals with some concerns about the growth of the order book that we'd like to see the company address in the next couple of quarters. Technicals look like they're a compelling point with what we believe to be institutional accumulation. We think that a stop zone can be placed here without too much downside risk. We think that the upside could be very strong indeed. And so that's why we believe DataDog is an interesting buying opportunity. Thanks for watching. If you'd like to hear more from Cestrian Capital Research, head to our website where you can find all of our stocks research services. You can get a ton of stuff for free, and you can, if you want to, subscribe for the premium work, which starts at a very low monthly price. We offer services from $9 a month up to our premium service at a couple of $1,000s a year. Head to cestriancapitalresearch.com. That's cestriancapitalresearch.com. And don't forget to subscribe to our YouTube channel and follow us on Twitter, where we are at Cestrian Inc. At Cestrian Inc. on Twitter. And again, subscribe to our YouTube channel. Thanks again for watching.